In this week's update, the tech correction continues, but really there's nothing to see here. This is just reversion to the mean. And lighten off on gold stocks. My name is Garry Davis, and as always, this is general advice only. And remember to like and subscribe to the video. All right, this doesn't need to be a long one this week because nothing much has changed from last week. We've got the continuation of the correction that we had to have, I guess. The important point is that money is not leaving the market. It's not going somewhere else. There is not great overall concern about the market going down a significant distance. This is really just a rotation. It's normal. We had excess in certain parts of the market, being technology, biotechnology, and a few other areas. And that money is just rotating temporarily into financials, into industrials, and into some other defensive areas of the market. If we look at XLK, which is the ETF covering the technology sector, it's retraced 15%, which, okay, that's meaningful, but that's after an 87% run from the March lows. So it's pretty normal to get a bit of a pullback when a market or a sector has gone up nearly double in 6 months. It would be unusual for that not to happen. So I don't think we should be reading anything more into this other than what it is. It's just a normal garden variety pullback from an excess. And if you look at Apple, Amazon, Microsoft, and Google, have contributed more to the decline than all the other stocks on the market combined. Okay, now I understand that they are big and therefore they have a very significant weighting on the indices, more than the other stocks. But it still points to the fact that this is just a correction in a very small number of stocks that have just run too hard. So we saw a lot of activity around the call options market, and that was one of the things that concerned me and why I indicated that we might be looking at a top in the market 2 weeks ago, and then that's how it played out. And that just all created excess fueled by traders, either retail traders, so-called Robinhood traders, or whether it's very large investment houses like SoftBank in Japan who are responsible for this. It doesn't really matter. The fact is we had an enormous excess in the call option market, and that's now correcting itself. The other reason that I'm pretty relaxed about the market overall, and this is really just a period to sit back and wait a bit, is that the VIX has settled down really quite quickly, and it's back down to 26.6 after hitting an intraday high in the mid-30s last week. So let's just take a quick look at that chart, because that, sorry, that's not the right one. That's the right one. So here's the VIX over the last month. So we've been running around the low 20s, which was a pretty elevated level anyway. And then we got a spike up into the low 30s when this all started to unravel. But look at over the last few days, particularly the last 3 days when the market has gone down, the VIX is going down as well. So I don't think, this is telling us very clearly that this isn't going to amount to anything particularly significant. That's certainly how I'm reading it at this stage. And again, technology has led the way for most of the last 5 to 10 years. There's no reason to think that that's going to change, because it's technology in all its various forms that have got the tailwinds. And I think that's just going to continue. So once this reversion to the mean plays out, then it will set up, I think, outstanding opportunities in the technology area. So turning to American stocks, the S&P fell another 2.5% for the week. It's down to 33.41. And we're now into the C leg of an ABC correction. The B leg was pretty short, only lasted about a day and a half. And you can see there the impact of the selling in technology. The NASDAQ was down 4.6, so nearly double the amount that the S&P was down. The US dollar had another small bounce up to 93.33, but overall still in downtrend. So this is, again, just normal. This is just a little counter-cyclical bounce in what is an established downtrend now. And the 10-year yield was lower to 0.67. So let's take a look at some charts. So here's the S&P. So the one thing I want you to take a look at is just the orientation of the various moving averages. So the red line is the 200, the blue line is the 50-day, and the green line is the 20-day. So they're all stacked up in a positive direction, one above the other, as you would expect. And the price has now come down, and it's still tracking around about the 50-day on the S&P. Now, it's possible we could go a bit lower. We could end up down around this 3230 area. But as I keep saying repeatedly, looking at the index and making decisions around the index is often a very misleading thing to do. Just focus on the stocks that you're interested in trading, because they can be doing something quite different from the index. If we look at the NASDAQ, you can see that the orientation still of the moving averages is very similar to the S&P, but in fact stronger. The 200-day moving average, the red line, you can see is inclined up at a really quite strong angle, whereas the S&P was effectively flat. And again, we're back to the 50-day. So on the surface, it doesn't appear to be any worse than the S&P, but it's just that the NASDAQ has come down from a higher level. Whether it continues down further or not, it remains to be seen, but it doesn't really matter. We just need to wait and let the market show us the direction that it's going. Okay, let's just look at the currency while we're here. So quite a strong downtrend since the highs in March. We've fallen from about 103 and we're now down into the low 90s. We're getting a little plateau, a few bounces up and down, but there's no reason to suspect that after this period is complete, that we may in fact head back down again. But look, currencies are just such a complex area. It's not an area that I feel at all confident in calling direction. I'm just merely an observer in what the currencies are currently doing. So turning now to Aussie stocks, our Aussie dollar was slightly lower again, down to 72.6. And the big swing factor for the Australian dollar and for the Australian economy is obviously the iron ore price. And the iron ore price is still very strong, but there is any number of reasons why over the longer term that is unsustainable. And of course, one of those is the direction that China is heading. What concerns me, and I raise this as it relates to the Australian dollar, is that our economy is increasingly resting on pretty unstable foundations. There are a number of aspects to this, and I would point to obviously things like trade, where we're really not sure what China might do next when it comes to imposing restrictions on the sale of our goods into China. You look at the state and federal function, or lack of it, that we're seeing at the moment around borders. You look at Australia's long-term lack of value-add manufacturing. We still are so incredibly reliant on just digging it out of the ground and sticking it on a ship without adding value. That I think our economy is increasingly at risk, and particularly with some of the actions coming from China at the moment. And I just can't see long-term how that plays out well for the Australian dollar. But anyway, that's the fundamentals. And as always, I think we should place more weight on the technicals and what the charts are actually saying. And at the moment, the Australian dollar is showing strength. Now, the ASX 200 lost 1.1% on the week, less than the US. But that was because we'd already had some degree of significant sell-off the Friday in the week prior. So some of that selling had already occurred. Let's just check on the ASX 200. So you can see we got up to a peak in early June, around 6,100, 6,200. And then since then, it's just effectively gone sideways for the last 3 months. And now we're starting to roll over. So the index may, in fact, head a little bit lower from here. All right, let's look at precious metals. So this is gold now on a weekly chart. So let's pan back and get a big grab here. So here was the previous high in 2011. We then went into a 7-year bear market, and we emerged from that bear market, started trending up early in 2019, and you can see it went really quite exponential and got well outside the previous channel that the price was tracking in. Now we've come back, and the previous high from 2011 is still holding, so that's the good news. But as I'll get to in a minute, there's some reason to suspect that that may not be the case in the shorter term. And a couple of other levels that I'm looking at: 38.2% retracement of this rally from the lows that we saw in March. Comes in around 1840, so I think that's a level to look at if this support level breaks, and I think there's a reason to suspect that it may break. And then we've got some more support coming in here just under the 1800 level, which is picking up this prior important peak back here. So that's the big picture on gold. Just looking at it on a daily, and really just going sideways over the last couple of months. And if we look at silver as well, silver also has been stronger, but is also just going sideways. Now, just to get to my point, I'm not sure this is how it's going to play out, but I'm just sort of ringing a little bit of a warning bell here that maybe lightening off on gold might be a prudent step to take, because if there is a correction in gold, it tends to be savage, and it tends to get amplified in the stocks. So if you're a trader or investor that's sitting with a very significant level of gold stocks, you might just want to review that in terms of short-term impact. So gold ended up rising $7 on the week. We finished at 1941, so that's all good. But the thing that concerns me, and again, I'm looking at indicators in other markets, as I did a couple of weeks ago when I got concerned that we might be reaching a high in the general equities market. The fund flows into GLD, and I've been showing the next slide regularly throughout this year, but the fund flows into GLD have stalled. And the concern with that is that jewellery demand is typically 50% of the total pie and has been for many, many decades. So jewellery demand is very weak at the moment as a consequence of COVID, for one thing. And it's only been the significant inflow of investment money into GLD that has sustained this rally in gold, because jewellery certainly hasn't been doing it. So with those fund flows stalling, and I'll show you that slide next, you've got to think, well, maybe the support level may not hold. And as I've indicated there, the downside targets 1840, 1790 would be two areas to look at. Now, let me stress, this may not come to pass. The fund flows might just be stalling and then they pick up again for whatever reason. I can't speak to the reason why those fund flows have stalled. I'm merely observing that it has happened. And if that were to lead to a period of some liquidation, because there's a lot of leverage, particularly by the futures speculators, they use a lot of leverage, typically 20 to 25 times, then gold could reverse. If the support breaks, gold could reverse fairly sharply. So this is a recommendation for the shorter term only, because you can always get back in again. So despite what is a very highly supportive backdrop, and that was what I showed last week, I just went through and ticked all the boxes, why this environment is so positive for gold on the medium to longer term. And I don't draw back from that at all. This is purely short term. So I think it might be just prudent, if you've got a very high level of exposure to gold and silver stocks, maybe just take some profit off the table and just sit back for a few weeks and let's see what happens. Because right now in the short term, and I'm sure talking the next couple of weeks only, we've got more downside than upside. But it's just, I've seen these periods in the gold sector before, and the impact on stocks can be very sharp. So let's just take a look at GDX as well. So no real impact on GDX, although I did note on Friday night that with gold up, GDX was down. So, again, that's just one little flag that just bothers me a little bit. But look, the main one is the stalling of the fund flows into GLD, and we'll look at that next. But the other point that I'd also make too is that the local gold IPO market in Australia is just super hot. I've just never seen it as hot as it is now. And that's another little warning flag as well. Gold stocks with gold companies with virtually nothing to offer other than a bit of a story are drawing in heavily oversubscribed capital raisings. And generally that doesn't last all that long either. So the whole thing to me, just as I said a couple of weeks ago, the general equities market, it just looks a bit unstable. It looks a bit unsustainable. And I'd rather preemptively pull back a little bit and just see what happens, because it's hard to see that you're going to miss out on too much upside in the short term. So here's the GLD holdings that I've been showing on a number of occasions during the year. So you can see that we've returned almost to the level that the market was at in September of 2011. But you can see the build-up that occurred this year. We went from 37 million ounces in June to 38.5 in July to 40.3 in August. But we've now leveled off and we've come back again. And if you look at the holdings on a day-to-day basis, which I do, there's a spreadsheet you can access. You can see that there is a definite trend there. It's definitely stalled and starting to roll over. So it may not amount to anything, but then again, if it does, it could be a little bit painful in the short term. So just look at your holdings in that context, and if you're going to do it, then do it now. Turning to other commodities, copper rose very, very slightly, but that's really quite interesting given that the US dollar was up a bit as well. So copper is doing quite well. And this is all part of money moving back into commodities. I expect the next maybe 4 to 5 years, late in the economic cycle, to probably be pretty strong for commodities. And we're seeing it not only in base metals, but we're also seeing it in soft commodities as well. Agricultural commodities are starting to pick up momentum as well. But going the other way, crude oil absolutely plummeted down to 37.5, and we saw a little minor breakout a few weeks ago, which now looks like a false breakout, and crude oil is back down quite sharply. So there's the spot copper chart. So wrapping it up, we just need a bit more patience here. I don't know how much longer this is going to take to play out. My guess is somewhere between 1 and 2 weeks more for this correction in the US to play out. That'll have an impact on sentiment. Obviously, when the indexes go down, it affects sentiment and stocks tend to get sold. But look, all it's doing is setting up wonderful opportunities. And that's the thing that everyone needs to focus on. The drivers of this correction are quite transient. It's not because results are not good. It's not because suddenly the economy looks bad. It's not because central banks are suddenly changing policy that would be negative for the market. It is purely because the Apples and the Amazons and the Googles just ran too far, too fast, and they're coming back, and we're just getting a reversion to the mean. So as I indicated last week, this is a period, get your watch list ready, get your strategy prepared as to how you're going to trade those stocks, and don't just buy something without knowing exactly how you intend to manage it. I get lots of questions from people that have bought a stock weeks ago or months ago, and then it does something different, and they say, well, what should I do now? Well, the time to think that through is before you buy it, not after you get broadsided. And you can have different strategies for different stocks. It's just a matter of being clear about how you're going about it. Portfolio analyst this week, again, it's just probably not too much to do. It's really just getting all the boxes ticked, positioning for the next phase, looking at the strategic setups, and there's just so many of them, it's almost overwhelming. That's it for this week. There's more information on my website, and there's my email address for anyone that would like to contact me. So that's it for this week. Cheers.